Welcome to the Strategic Profit Model. This is Mark Spielis at Central Michigan University. You might be wondering, why am I starting off a finance strategic profit model with Terra Firma, a craft brewer from Traverse City? I will make that connection at the end here. So welcome again. This is Mark Spielis at Central Michigan University. And we're going to cover one of the first 5 methods we've covered. There's 6 in total. And today we're going to cover the strategic profit model through an exercise. It's so much better to go in and actually work through some of these exercises and understand the concepts better as we work through it. So we've studied 5 of the models so far through this session. The next session we're going to get into economic value add. In this exercise we're going to look at the strategic profit model. The strategic profit model integrates efficiency, which is the cost improvements, with revenue generation, the ability to generate more revenue. So it's that measurement that incorporates both of those into looking at the value of logistics. So this model that we've been looking at, the strategic profit model, it's been around since 1920. So why are we still using this model? It's effective. It's still effective today. It's still being used in business today. So let's explore a little bit further. So the strategic profit model really measures a company's ability to turn assets into profits. So we in logistics, we handle a lot of assets, okay? So it measures our effectiveness of how we create profitability for a firm. All right. So two of the foundational measurements of the strategic profit model is number 1, return on assets, ROA, which is your net profit margin times your asset turnover. Asset turnover being sales over total assets. It really tells us how effective are we at using our assets. All right. Another option, I like to use this to calculate your return on assets, is your profit margin in dollars over your total assets in dollars. It's a more straightforward formula. And it also integrates return on net worth, RONW. Okay, so that's our net profit over our net worth. Our net worth calculation for that is your total assets minus total liabilities. All right, so I like this approach because it's a holistic approach. It integrates both the balance sheet as well as the income statement. All right, so when we look at the income statement, some logistics impacts that go in and impact our income statement positively is, number 1, as a result of logistics, perhaps we increase our revenue or increase our sales. So that would be 1. Perhaps we bring down our costs, inventory carrying costs, transportation costs, warehousing costs. All of these costs that we've studied so far, we're now reducing those costs. So the impact to that is on our sales. It's either increasing our sales or decreasing our cost of goods sold, our cost, okay, which has a positive impact on our net profit margin. So all of these logistics impacts that we've just referred to go in and they impact our net profit margin positively. All right, so the net profit margin along with our asset turnover going to give us that calculation of return on assets. Return on assets times our financial leverage gives us our return on net worth. Okay, so if we look at this formula though, and we just take a moment to dissect this formula, I'm going to throw in a highlighter here. All right, so I should have used a pen. Let me use a pen here. Okay, so if we look at, first of all, financial leverage and return on assets, they really have a common item here, which is our total assets. So if we take total assets out of that formula, it leaves net profit over net worth, and that is our formula here for return on net worth. Boy, that is a terrible circle there. All right, so at the end of the day, we're trying to get to this calculation of return on net worth. That is our ultimate formula. All right, Next on the balance sheet. Now we're looking at balance sheet items, so inventory, accounts receivable, and our logistics processes have a positive impact on that. We've talked earlier about reducing inventory. So the reduced inventory, perhaps we're servicing our customers better, so we're getting paid faster. So that would impact our accounts receivable, driving our accounts receivable down. So both of those are current assets. So the impact of that is we have a lower current asset. So again, we're reducing current assets. And perhaps through more efficient operations, we're reducing the warehouse space use as well. All of these inputs go in to reduce our asset turnover. So let's assume that our sales go up, but all these other costs, these total assets, go down, right? So that will drive our our asset turnover up. Again, that formula, asset turnover, goes into our return on assets, again, driving our financial leverage as well as our return on net worth. Okay, so that was just a summary. And again, net worth, total assets minus total liabilities. Sometimes it's referred to as shareholders' equity. All right, so you will be working on Project 3. Part of that Project 3 is going to be calculating the strategic profit model as well as EVA. I'll get into EVA in the next session. All right, so for you, continuing research, right? So continuing research for this podcast involves Terra Firma. Here's the connection. Terra Firma, craft brewer in Traverse City. And Terra Firma, owned by John Niedermeyer, they're going to move to, or they're considering moving, John is, to a self-distribution model. They want to get out of utilizing their distributor, which is H. Cox & Son. All right, so they're going to remove the middleman, as I just did there, and they're going to distribute directly. Terra Firma will distribute directly to Meijer and Kroger. So they're going to use self-distribution for this, eliminating the need for H. Cox & Son. All right, so the exercise you're going to work on, I first give you Terra Firma with a distributor model. In other words, when you look at their net profit margin, their net profit margin is 4.118, all right, and their return on assets 17.28. That's calculated over on the far left here. So here's our net profit margin. Again, not a great circle there with my oh wow. And then the return on assets is 17.28%. All right, the calculations all come from right to left. So our cost of goods sold over sales, it's going to give us our gross margin. So sales minus cost of goods sold give us our gross margin, reducing or taking our gross margin, total expenses, income taxes, gives us a net profit in dollars of $700,000 over our sales, gives us our profit margin of 4.118. All right. Same thing with return on assets. You can see the calculations here go right to left. Inventory, accounts receivable, both go into current assets. Our fixed assets as well as cash, So inventory, accounts receivable, as well as cash, all go into our current asset account. Our fixed assets are $2 million, So these are all the functions that go in to help us calculate net profit margin as well as our asset turnover. And in this case, there's impacts to both of those. All right. So the impacts to both of those elements come in the form of moving to a self-distribution model. All right. So self-distribution. I mentioned earlier one of the positive impacts is its impact on sales. It's going to increase sales by 15%. The cost of goods sold, however, is going to go up. So they're going to need more materials, maybe higher administrative expenses. They're going to have to hire supervisors. So cost of goods sold goes up by 15%. The self-distribution model is going to increase their inventory, right? They have to hold on to more inventory because they're doing the distribution themselves. Inventory goes up by 20%. The self-distribution model will increase accounts receivable by 10%. So now, as opposed to having one person that they need to get paid from. That would be H. Cox and Sons. Now they're waiting to be paid by Meijer, Kroger, other perhaps liquor stores around the Grand Traverse area. And lastly, their fixed assets go up by 50%. Trucks, trailers, perhaps material handling equipment, warehousing space. So they've significantly increased their fixed assets. So with this model, you're going to ask yourself, okay, should Terra Firma, should they pursue this? Does this make sense for Terra Firma to pursue this? And you're going to do that by applying the strategic profit model, okay? So I'm going to ask 4 questions. What is the profit margin for the self-distribution model? You've already seen it for the distributor model. What's the impact of self-distribution on the asset turnover? Does it go up? Does it go down? What is the return on assets under the self-distribution model? Then lastly, I'm going to apply it again, the profit leverage effect. Okay, so Terra Firma can source a local hop supplier and it decreases their cost of goods sold by $200,000. Okay, so what is the profit leverage effect? In other words, how much more does Terra Firma need to sell to maintain that same profit margin? Okay, so you're going to apply again the profit leverage effect. Remember, the first thing you want to do with that is, this is under the distributor model, is determine, what is their profit margin right now? What is their current profit margin? All right, so that's a frame up of the exercise for class for today. Hopefully that was beneficial to you. And so if there's any questions, feel free to reach out to me. It's Mark Spielis at Central Michigan University. Make it a great day. Thank you.